Hello and welcome to today's video about 401k options after leaving the US. In this video, we will discuss various options you can consider to manage your 401k funds after moving out of the US. Before we dive into the topic, we want to remind everyone that this is not financial or tax advice. This is done for information purpose only. Please consult with your financial advisor before deciding which option is better for your needs. First, you need to decide whether you want to leave the money in the US or transfer funds out of the US. The first option to consider is to leave your 401k funds in the existing employer plan. This may be the easiest thing to do, but not necessarily the best option. If you choose not to transfer or roll over your 401k funds, you may still be able to leave the funds in your existing 401k account. However, this may not be the best option if you're no longer working for the employer who sponsored the plan, as you may be subject to higher fees or limited investment options. Another option for managing your 401k funds after moving out of the US is to roll over the funds into an individual retirement account, IRA. This can be beneficial because it allows you to continue to defer taxes on the funds until you withdraw them in retirement, and it may also provide more flexibility and investment options compared to a 401k employer plan. Another option to consider is converting your traditional IRA or pre-tax 401k funds to a Roth IRA. With a traditional IRA, you get a tax deduction when you make contributions, but you'll have to pay taxes when you make withdrawals. However, with a Roth IRA, you don't get a tax deduction when you make contributions, but you won't have to pay taxes when you make withdrawals. If you expect to be in a higher tax bracket in the future, converting your traditional IRA to a Roth IRA could be a smart move, as you'll pay taxes at your current lower tax rate. This could also be beneficial when you are in a lower tax bracket and in a special RNR, resident not ordinary resident, status in India, where you don't pay taxes in India for global income during this status. One has to pay a penalty for early withdrawal of 401k funds, 10%, but depending on your situation and planning, this could be a very good alternative. The final option to consider is withdrawing your 401k funds. If there is a need for funds, or you are not expecting to be income, lower tax, or the amount of money in your 401k is small, you might want to consider withdrawing the funds. Withdrawing 401k funds while in RNR, resident not ordinarily resident, status in India, which can be a tax-efficient option. As an RNR, you are taxed only on the income earned in India, which means that you may not have to pay taxes on the 401k withdrawal, which is considered foreign income. However, it is important to note that there are still potential tax implications, and it's crucial to consult with a tax professional before making any decisions. Additionally, there are penalties for early withdrawal of 401k funds if you are under 59.5 years old, which can significantly reduce the amount you receive. One pro tip: Fidelity, TD Ameritrade, and Vanguard institutions let you manage your IRA accounts that are opened in US after moving to India. In summary, there are multiple options available for managing your 401k funds after moving out of the US. It's essential to weigh the pros and cons of each option and consult with a financial advisor to determine the best course of action based on your individual financial situation. Thank you for watching today's video, and we hope you found this information helpful.